Welcome to this month's Market Update. I'm here today with Casey Lowe, Principal Consultant at Frontier Advisors. Hi there, Casey.
Wayne.
Well, the world is really watching events unfold in the Middle East. Of course, we need to remember that is a man-made humanitarian crisis. It impacts so many people in so many different ways. Our job is to look at investment markets, and indeed, investment markets are impacted by those events, aren't they, Casey?
So I think the key economic linkage that we're currently observing is the flow through on to oil and energy markets, which will have impact on inflation and then central bank policy actions. So the concern is that, or the risk is that the current conflict in the Middle East expands out, broadens out, and leads to a disruption to global supply chains and a larger disruption to global oil supply, which would likely mean that oil and energy prices increase, and that would mean inflation increases as well, which would mean central banks would likely to keep interest rates higher for longer, if not have to increase interest rates further, which would be negative for financial markets. And this is one of the things that we saw last year when the Ukraine and Russia war occurred.
Yes.
But when we look at what's currently happening in the oil market, so oil price did initially spike up when Hamas attacked, but actually oil prices have now fallen back to below those levels, which is suggesting that the market thinks the risk of this becoming a broader conflict is not that high right now.
Yes. Now, closer to home, the Reserve Bank, new governor, first major decision. Talk us through that, Casey.
Yes. So at the November meeting, the Reserve Bank of Australia has hiked the cash rate again. So it's 4.35% now. Now this is after keeping the cash rate on pause since their June meeting. So it's they've kept it on pause for quite a few months now. The reasoning for why they have increased the cash rate again is because they see inflation to be quite persistent, and they think the risk of inflation staying higher for longer has increased. And they have named three factors for why they think that risk has increased. The first one is that the labor market remains very strong.
Yes.
They think that also when you look at services costs, that has increased a lot too. And the third one is that house prices are increasing again. So those three factors have led to them to increase the cash rate again, just to be sure on keeping inflation or bringing inflation down. As a result of the latest meeting, the market expectation has changed. So before this meeting, the market was expecting the cash rate to actually start to fall around the middle of next year. But since the meeting, market expectations adjusted, and they think the cash rate will get to around 4.5%, so roughly another hike to come. And for the cash rate to stay at around 4.5% all the way to at least end of next year. So some significant changes in expectations now.
Yes. And of course, interest rates are one factor that really puts a lot of pressure on households, but households are feeling financial pressure from a number of sources, aren't they, Casey?
Yes. So that's a key risk for the economy, and the Reserve Bank of Australia has been publishing quite a number of research papers over October and November covering this in quite detailed analysis. So one of the analysis looks at estimated costs of living expenses, essential living expenses, and they looked at the share of owner-occupied mortgage holders where the cost of living expenses are exceeded by the income. So that number compared to the middle of last year has increased from 1% to 5%. Which still seems like quite a small number, but if you broaden the definition to include other expenditure which are more difficult to adjust in the near term, for example, like private health insurance or private school fees, those numbers go from 3% to 13% over that same period. So quite a big increase there, and it's getting quite material. Now, this 13% is not, these households aren't necessarily facing financial stress, but certainly they may not be able to meet the expenses just by reducing them anymore. They may have to dip into their savings to meet those expenses now. There's also quite a number of other indicators that the RBA has been tracking to monitor financial stress in households. So one of it is Google searches on financial stress. or the term financial stress, and that has increased to a level not seen since the start of the pandemic.
Right.
We've also seen consumer sentiment surveys on family finances drop to record low levels now. And one other indicator that the RBA showed was the number of calls to the National Debt Helpline, and that has increased quite sharply over recent months. So it goes to show that financial stress in households are increasing.
And the repercussions of that for individual families and households are sadly quite obvious, but what are the repercussions for the broader investment markets?
Yes. So unfortunately, in the RBA's effort to reduce inflation by increasing interest rates, it has also led to increases in financial stress for households. And what this means is that households feeling this financial pinch will likely be cutting back on expenses and consume less, which will flow through to corporate earnings. And as a result, we're likely to see there's more risk to equity markets.
Well, KC, we've covered a lot of ground today. Thank you for that. And thank you for watching this month's Market Update.